And of course, real estate is one of our top industries. And it's to Sarasota very much like autos are to Detroit. When times are good, they're very, very good. And when they're not good, well, you know. We've had that experience recently. So there's so many important issues tied into real estate as a business and as a lifestyle. We really want your active engagement tonight. We have a great group of panelists that you'll hear from first, moderated by Tom Tryon, who I'll introduce in a minute. First, I want to do some thank yous. I want to thank our marketing team led by Marketing Director James Holmes. If they would stand or raise their hands, they may all be out front. But here's, where'd James go? Here's James. Great, thank you. They've worked very hard on this series, organizing it as well as marketing it, and they market a lot of things that we do, including Season of Sharing, which we just concluded with $1.5 million in donations this year. Thank you. Thank you. I also want to thank New College, our partner with this series. We've had each session here in this facility, and it just works beautifully. It's a wonderful facility, and we're grateful to New College for letting us come here. METV is videotaping this, and we'll be posting that on our website. Tom is going to tell you how you can find that. But for those of you who would like to review anything, or if you want to share with colleagues what happened this evening, you'll be able to access the videotape on our website. And finally, again, thanks to all of you for coming. I know you're very, very busy, and we appreciate the time you're taking this evening to be here. And we do hope that, that you'll actively participate. So with that, I want to introduce our moderator, Tom Tryon. Most of you know Tom as our opinion editor. That is a newfangled term for editorial page editor. And what it means is that he coordinates opinion, the publication of opinion, online as well as in print. Tom's been with the Herald Tribune for 25 years. He started with us as a reporter and moved up the ranks. And I like to say he's a Florida cracker, born and raised in Palmetto, and played on the high school championship football team when he was in high school in Palmetto High. Yeah. All right, Tom, do you want this?
No, I'm good. Thank you. Thank you, Diane, very much. Yeah, she's one of those too, Lake Wales, Florida, the big city of Lake Wales. Okay, are we good? Can everybody hear me? I always, in Sarasota, always ask that question. Sound good? I don't want to have the hair. Speak up from the back. So if we're good, thank you. Let me quickly outline our program so we can get to the fun and games. We're going to have 4 parts in this event tonight. One is a presentation by real estate analyst and occasional Herald Tribune contributor, Jack McCade. The second is a panel discussion, and I'll introduce the panel in just a moment. The third phase will be some questions for some of our audience. And then the final phase, phase 4, will be questions from the audience. And we're going to try to devote at least 25 minutes to the Q&A, so everybody will get a chance, or a lot of people will get a chance to weigh in. Hopefully, together we will answer this question. Is 2012 the year of the short sale? And if so, what does that mean to the real estate market, to the economy locally, and to individuals? Let me just give a quick programming note. As Diane mentioned, METV is recording tonight's event for broadcast later. That'll be on Bright House 614, Comcast 19, and Verizon 31. So since we have cameras in the room, we ask you to stay seated during the event unless you have a question. We don't want to get your best side on the cameras back there. So let me introduce our panel and then our guest speaker. Since we have a jam-packed agenda and want to leave plenty of time for questions, please refer to your programs for the short biographies of our panelists. So let me just say right now, here they are. Michael Braga, if you come up on stage, Michael Braga is a Herald Tribune business and real estate reporter, and he'll be in chair number 1. Harold Bubel, Herald Tribune real estate editor, and you are down on the end in number 4. Tom Avrudis, attorney and shareholder with the Sarasota law firm of Hodges, Avrudis, and Fuller. Thank you. And Nancy Kaysen, attorney and managing partner of the Sarasota law firm Seipert Meshad. The bio for our guest speaker, Jack McCabe, is also in the program. So without further ado, here's Jack McCabe for his 15 minutes of fame in Sarasota. Jack.
Thank you all very much. Good evening, ladies and gentlemen. I'd like to thank you for coming to the 2012 Real Estate Year of the Short Sale, sponsored by the Sarasota Herald Tribune. The big question of the night is this the year of the short sale? And the short answer is yes. It's also the first of several to come. But first, what I'd like to do is, and what's always very interesting is when I get a crowd together like this, is to do a little straw polling. I think you also will find it interesting, and hopefully the folks at home will as well. I'd like you all to raise your hand if in the last 5 years you know someone, a friend, family, coworker, somebody at church, that has lost their home to foreclosure. Could I see a raise of hands? Why don't you all take a look at the crowd here? I think you'll find it interesting. Next is, do you know anybody who is currently in foreclosure? I'd say that's a majority of the crowd. Do you know someone who has lost a full-time job and is unemployed in the last 5 years? It's most everyone. Do you know anyone who has lost their job and is now working a part-time job for a drastic cut in pay? How many in the room currently owe more on their mortgage than what they can sell their home for? And how about, does anyone know someone who is collecting welfare right now to pay the bills and put food on the table? Well, I asked those same questions the last time I was here to speak in Sarasota about 3 years ago, and about half the crowd raised their hands. And I'm sure, as you noticed on some of these questions, it was about 80–90%. Let's start with where we're at here at the beginning of 2012. And I'm going to paint maybe a not-so-rosy picture for y'all, but I think there are things that not everyone takes into consideration, like an analyst like I do. Currently, there are 348,000 open foreclosure files in Florida's court systems. That's down from 371,000 in October. There are 530,000 more mortgages that are in default, meaning that folks have not made their payments in 90 days or more. Of those, about half, over 250,000, just here in this state, have not made a payment in over 2 years. Right now, it takes 806 days to process a mortgage here in Florida. That's about 2 years and a quarter. That means that some people will actually live in their homes for over 4 years in this stretch without having made a house payment before they actually get evicted. It's incredible, isn't it? The banks on top of that hold an additional 150,000 homes here in Florida, what's called REO, or real estate owned, meaning they foreclosed, the people have been evicted, the banks have taken them back, they haven't sold them yet. In total, that is over 1 million distressed homes here in this state. Right now, our unemployment rate is at 9.9%. That's the first time it's been under 10% in the last 3 years. It's far above the national average of 8.3%. The U.S. Census American Home Survey estimates Florida population increased this last year by 250,000, which is great news. But that is the first net population gain that we've had since 2007. We actually had a net loss in 2008, and in 2009 and 10, it just made up for the loss we had in 2008. So we had 3 years basically of net zero population growth before this last year. And that, once again, is an estimate by the U.S. Census. This is kind of staggering to me when you think about it, but right now, 1 out of every 6 Floridians, over 3 million, are currently collecting welfare, dependent on the state right now to help pay their bills. The Florida state budget this year is estimated to be $2 billion underfunded. This is the 5th straight year in a row now where it's going to require budget cuts, and as we know, many of those have been drastic. They've affected a lot of social services. Florida's home ownership to renter rate, percentage of owners, or home buyers basically, the bank really owns the home until you pay it off, and then you're a homeowner. Until then, you're really a home buyer. But the home buyer to renter rate was 69.1 to 39.9 at the height of the market. Almost 70% were buying their homes. That rate has now dropped over the last 5 years and is 64.1 to 35.9. And I believe this is part of a long-term trend that we're going to see from people switching from buying homes to renting homes for the foreseeable future. The banks have also gone through a paradigm shift in processing short sales. A year or so ago, as most any agent can tell you, or somebody who is trying to transact a short sale, it was difficult, if not impossible. You would make an offer to the bank. It might be 5 or 6 months, in some cases a year, before you heard back from the bank, gave you an answer, and a lot of times it was just a flat no. They didn't even come back with a counteroffer. Times have changed. With all these distressed properties and a lot of banks that could go under if they don't do something with their real estate portfolio, we're now seeing banks are soliciting short sales. An example, I talked to a lady not long ago. I get calls, emails, letters every week from people asking me to help them try and save their homes. It's heartbreaking at times.
Because I feel for these people.
But I had a lady call me and said, Jack, you know what? I got a letter from Chase the other day, and I owe $215,000 on my mortgage. I've made a payment in 2 months now. And I would like to get your advice. They're saying that if I put my home up for sale, that they are willing to accept $115,000. Now she owes $215,000. They won't file a deficiency judgment, and they've offered to give me $35,000 to move out. So take it. Say thank you. Take it. And that's what she's doing. Now, also what we're seeing is the banks are also starting to write down principal balances. As many of you know that have followed my column, I've been talking about this for about 3 years. That to bring some stability to the housing market, we had to stop this flow of foreclosures. We had to do something to keep people in their homes and to continuing to participate in our economy as consumers, which is 70% of our GDP. We're now seeing programs from the government that are going to pay banks triple what they had offered them before to do principal write-downs. A lot of different programs now to try and help keep people in their homes. The problem is they've got the apparatus right, but the funding isn't there. $19 million of the HAMP program, what's remaining is now going to be spent to write down principal mortgages. Well, I can tell you, you can do that alone just in South Florida, let alone the whole country. So we're on the right track, but we're still not there. This is going to help a precious few stay in their homes. And if you're an attorney and you're representing anybody right now who's in trouble, I would say get on the ball, because this is a chance of a lifetime for a lot of people. I had a lady that contacted me that she owed $450,000 on her mortgage. Her attorney was able to negotiate not only a loan modification where she got a 4% 30-year fixed rate, but they wrote down her principal balance from $450,000 to $250,000. $200,000 write-off. It lowered her payment by $1,200 a month, made it possible for her to stay in her home. And she'll be participating as a consumer in the future. This is the type of action that we need in these very drastic times. I can't stress that enough. while there's some green shoots, there's some notes of optimism. We've just gone through the Great Recession. This is the worst financial time that we've seen since the Great Depression. It is not over yet, and it is definitely not over here in the state of Florida. We're seeing some good things happen, but we still have a ways to go. Foreclosure filings last year were down by 67%. That in itself looks like good news. Problem was it was primarily due to the robo-signing debacle, as most of you are already aware, where we had a lot of attorneys representing different banks and also servicers of what's called residential mortgage-backed securities, and RMBS is a term you all may be familiar with now, that had hired attorneys and had just overwhelmed them with files to process. And they ended up, in some cases, subbing out some of the work, some to companies and firms in India and in Mexico, and they got back a lot of fraudulent paperwork. Florida's judicial law system requires that the person saying that they are owed the debt be in possession of that original note. If they're not in possession of it, technically they're not allowed to foreclose on somebody. It's considered a very serious offense here to throw somebody out of their home without the right paperwork. So that's something that was always demanded on here. But foreclosure filings were down by 67%. Now, since October, and they've gotten all these files straightened out, figured out which ones they can go ahead with, which ones are troubled, we've now seen the foreclosure filings increase consecutively the last 5 months by 30% or more each month. That's going to be a trend that we're going to keep seeing probably for the next year and a half. Short sale, foreclosure, and REO inventory absolutely dwarfs the average that's on the multiple listing service inventories. It's true throughout the state, and it's also true here in Sarasota and Manatee counties. There's been some good news coming out of the real estate, the realtor community. Sales have been up, inventory has been down. There has been some price stability in some different segments of the marketplace and some different price ranges. That's all good news. The problem is that the amount of distressed properties held by banks, what's in the courts out there right now, that is going to have to be transacted over the next 2 to 3 years, it's just, like I said, dwarfs what the average is on the realtors MLS. Those are going to be the price drivers for real estate coming up, is these distressed sales. It's going to be real hard to try and get what I would call a retail price when there's so many wholesale properties out there that are selling at 20 to 50% below what's being listed on the MLS. Now, it's been working this year because we've had a lot of foreign buyers in the marketplace. In South Florida, where I live, over 70% of the transactions were to foreign nationals, and over 50% of those were cash deals. It's still very difficult to get a mortgage. I hear lawyers and doctors tell me that they have banks coming back to them they've had relationships with for 10 years that are now requesting additional paperwork, additional information, 4 and 5 times. And it seems more that they're more interested in trying to find a way not to make the loan than to make it. And here the banks talk, they say it's a different story, but that's not what I'm seeing in reality. If you're trying to get a condo loan, as most anyone can tell you, it's nearly impossible. Unless it's an FHA loan and an FHA-approved property, it's very, very difficult. Just a couple of notes on some stats here in the Sarasota-Bradenton market. Single-family homes, the median sales price at the end of 2007 in this marketplace was $285,700. It was actually higher in mid-2006, but at the end of 2007, $285,700. At the end of 2011, the median price is $152,000. For condominiums, and this is according to the realtors' data, by the way, that I'm using here, and this doesn't include a lot of the foreclosures and short sales from the past year. For condominiums, the median sales price at the end of 2007 was $253,800. 2 months ago, at the end of 2011, it was $127,000. That comes fairly close to the 51% drop in prices that we have seen over the last 5 years. So to conclude my 15 minutes, and hopefully I didn't run over that, I wasn't paying attention to the girl. Oh, I got 2, okay. I may even have a joke for you here at the end. But what I see ahead for this year and for next is if you're an investor and you have a long-term investment strategy, say you're looking for somewhere to put your money for the next 5 to 7 years, maybe 10 years, this is the most unprecedented time that there is in our lifetimes, and will be for generations to come. You have the opportunity to buy real estate now at prices what they were 10 years ago, 11 years ago, 12 years ago. Now, I still think that prices are going to be flat or decline a little bit over the next year, year and a half. Then I think we're going to reach a period of stability once we wash through all these distressed properties. A lot of these are going to be sold to investors. It's going to be required of them to take the properties off the market and not sell them for the next 2 to 3 years. That should help stabilize the inventory and curtail the flow of distressed properties. That'll be a real good thing. But it's still, and then we're going to get back to a few years, I think, that's a more normalized rate of appreciation, which is about 3 to 5% a year, or about 1 to 2% above the typical inflation rate. That's what it's run over the last 100 years. We'll see a period of, that doesn't sound too good, but I really think that 5 to 7 years from now, we're going to go through another period of hyperinflation, of rising interest rates as well, but where we're going to see a period, and I really think that 7 to 10 years from now, the properties that you can buy, you know, on pennies on the dollar right now are going to be worth an incredible amount of money. So I think that there's great opportunity from an investor standpoint. If you're buying a home for your own family, if you're buying it for the right reasons, because it's in the right school district, the right neighborhood, where you go to church, close to your workplace, close to the beach, whatever it is, you have the opportunity now to buy a home, I think, at an unbelievable price and some incredible interest rates if you can qualify. So I think there is opportunity, but we still have a year and a half, 2 years yet that's going to be a rocky road. And on that, I thank you very much.
Thank you, Jack. Thank you very much. That makes me glad that I've stayed in the same house for the last 25 years, actually. Okay, so we're turning to the panel here, and let's talk a little bit about just very quick some reactions to what Jack said, and we'll do this on a first name basis. We'll start with you, Nancy. Tell us just very quickly generally what kind of law practice you have.
My practice area is real estate transactions and litigation and estate litigation. So primarily real estate litigation now is a lot of foreclosure defense, landlord-tenant work, title insurance issues, easement disputes, that kind of thing, homeowners association disputes. I would say of my real estate litigation practice, about 75% at this time is foreclosure defense work.
Okay, so what Jack described in terms of foreclosures, volume, processes, does that resonate?
He was exactly 100% right on the money of what I experience on a daily basis. And his emotion and the feeling that he feels when he deals with people is exactly what I encounter on a daily basis. As I tell my clients, there's no shame in this game, there's no blame, it's just you gotta get through it. And foreclosure doesn't discriminate. It doesn't matter who you are. I have foreclosures from $50,000 to $5 million and up. So it doesn't matter who you are, everyone was affected by the decrease in the real estate market.
Sure. Are the banks that you're dealing with, are they starting to move, starting to change their strategies a little bit?
I can't say that they're changing their strategies as far as litigation is concerned. What I am seeing is that they are more willing to do short sales. They are more willing to release deficiencies and let people move on, and they've streamlined what used to be a monstrosity of a process to something that's manageable now if you have the right people helping you through the process.
All right. Now, Tom, you have represented a lot of lenders, as I recall from our conversation. tell us a little bit about whether what Jack was saying, does that resonate with you? Is that what you're seeing?
Sure. Can everybody hear me okay? All right. What I do is I'm a debtor-creditor attorney, which doesn't mean that we do foreclosures. We don't. But what we do is we represent branch banking, Regions Bank, Sarasota Memorial Hospital, Lee Memorial Hospital, and anybody to whom a debt is owed. So when I listened to him speak, sure, it hit dead on. The only thing I might add is that what's occurred with my practice over the past couple of years, 2-3 years, is that we used to do all creditor work, and now we do a bit of debtor work where we're helping people that have debt to try and figure out and see their way through it. And I've just seen more stability. About the past 2 years, being in collections, we've just seen more money come in on a steady basis instead of the erratic numbers that we saw for a couple of years. So to that extent, it's, from my side, it's been great to see.
Okay, terrific. Harold, from where you sit and what you cover, what Jack said, is that what you're seeing in this market, what you're reporting on?
I would never dispute the statements of an economist. They have been right all along. Not necessarily the case, but you know, I do see that. I think the hidden thing, though, is the pent-up demand of household formation. As we have more jobs created, we will see people move out of mom's basement and start households. Our household formation has lagged, and our new home construction has lagged for many years now, 4 or 5 years, and that's creating this. We need to create about 1.2 million housing units in the country every year to make up for population growth, household formation, and obsolescence or demolition of obsolete houses. We haven't seen that. We've been way below that. I think last year we had about 470,000 housing units built in the country, including rentals. So we're way behind that schedule, and it's going to be interesting to see as the economy comes back, if and when it comes back, how this will play out. Jack, I don't know if you have a take on that or not, but it could be a situation where we can absorb that inventory quickly.
All right. Michael, is that what you're hearing? That's what you've reported, those numbers, those changes?
Yeah. I think Jack has consistently been one of the best big picture people in the state as far as, you know, getting things right as to where we're going and where we've been. Last 8 years, he's been right pretty much all the time. The one time I disagreed with him, I had ended up having to put on a bee costume and singing in the newsroom to another reporter that I bet with, because I thought that prices were going to go up rather than down. So I learned not to disagree with him as much. But I definitely think that this is the year of the short sale. And I think that the two people in the room that have taught me that more than anybody else are Sabrina Sullivan, who's sitting over there, and Nancy Kaysen, both of them who are dealing with short sales on large volumes. And they kind of presented to me you know, as an American, I think all of us are feeling that we've got a moral obligation to pay our bills and to, you know, not fall behind. And this is just who we are as Americans. We pay our bills. But the problem is so vast now, and the big ethical dilemma and moral dilemma that people come across is, well, wait a minute, what's best for my family? Is it best for my family to keep paying this bill and pushing this rock up the hill? Keep pushing it up the hill. Or just look at it like it's a contract. It's a contract, and I can pay a penalty to get out of it. There are penalties for getting out of that contract. Okay, so maybe it's better sometimes to pay that penalty. 3 years where if you go into a short sale, 3 years where your credit is bad, but like Nancy told me, basically a guy who buys a house for $250,000 during the boom gets a $250,000 loan. That house is now worth $150,000. He's $100,000 underwater on his loan. If if rates, I mean, if that house appreciates over, over time by 3 to 5% a year, it'll take 13 years to get back to zero, to get back to the break-even mark. So what's better for the person who's struggling with their home loan?
All right, so I'll just jump in there. So Nancy,
Sorry.
what do you tell people under those circumstances? What are the guidelines that you use, and what are you telling people?
Well, what I tell people is, first of all, of my clients that come in, I would say 90 to 95% of them have never in their life defaulted on anything. They've never not paid a bill, they've never defaulted on a debt. So when they come in, having been served with the foreclosure or reasonably likely to go into foreclosure, they're devastated. They feel like they are less than worthy. And I say, no, let's rewind. Let's redo your logic here. I am looking out for you. What is in you and your family's best interest? And we take it from there. I don't let them think that they're a bad person because they can't pay their debts. You have a constitutional right to file bankruptcy in this country. And Mr. Braga's right. You have a right to breach a contract and pay a consequence. And sometimes the consequence for breaching a contract is less than the consequence of fulfilling that contract. And as attorneys, we deal with that all day long. People breach a contract, you sue, you're responsible for damages, and you mitigate those damages and you solve your issues. 90% of cases resolve themselves by settlement and not going to trial. And so that's what I do. I do an analysis of the entire family situation. What is the income? What is the ability to pay? And what is your goal? Do you want to stay? Do you want to go? And then I get them to that goal.
Great. Now, remind me to come back to why short sales as opposed to foreclosures. But I want to ask Tom. So Tom, if you're on the other side of the table, you're representing a lender. How do you approach that equation? And also mention to me a little bit about, you said sometimes in our conversation we had before this, that sometimes short sales are not right for some people who say they want to have them. So it's a two-pronged question. From when you're representing lenders, how do you approach this equation? And then when is for a short sale the right thing to do?
All right, well, first of all, when I represent lenders, the lenders that I represent are suing on an unsecured debt, which is usually the equity line. So we file suit on that equity line, we get a judgment, and then we go out there and search for assets to take. So I'm the bad guy that people don't like when they see me coming, because we go after whatever real estate they have that might have equity, go after their cars, go after their businesses, go after garnishing their wages or their bank account. So from the lender's standpoint, they're like any other creditor. They're trying to get paid. But when it comes to the short sale, part of my business also is sitting down with people and making a decision. What is it that they need to do? Sometimes a short sale is the best option, but like Nancy was saying, it's exactly right. You look at the whole picture, and there's a lot more to it than just a house. There's their credit card bills, there's their 401k, there's the rental properties that they have, there's a husband and wife, there may be kids that are involved. And you look at the whole picture and come up with an answer as to whether a short sale is the best option. Because many times, someone might be underwater just a little bit, and it's not the best option.
All right, so circle back to Nancy. Why short sales now? Let's say this is the year of the short sale, you believe?
I agree 100% that this is the year of the short sale. Next year's probably going to be the year of the short sale. Last year was the year of the short sale.
So tell us why short sales as opposed to conventional foreclosures or other means, just waiting out the storm, waiting until they come and throw you out.
Yeah, I always want my clients to be proactive. I think there's this misconception out there that people are just trying to stay in their homes and not pay, but that's not my experience. My experience is people have an issue, it's weighing on them on a daily basis, they want to move forward, they want a plan of action, and they want closure and to move on with their lives. And I usually take the statistic of a 5% increase per year, which, assuming we're at the bottom, which, it doesn't look like we're all the way there, or we might be there. How long is it going to take for your property to break even, and do you want to stay that long, and is it in your best interest to stay that long? A short sale, just the basic for if anybody doesn't know what a short sale is, where you sell your property to a third party for less than the amount that's due, and the lender has to expressly permit that. They have to permit it, and they may or may not waive the deficiency being the difference between what they net from the short sale and what's owed on the loan. So the goal in a short sale for my clients is to get a short sale approved with a deficiency waiver so they can walk away with their dignity and start over fresh and clean and just have a clean slate on their lives. That's what people want. And so I really try to quell that misconception of people are just camping out and they don't want to pay and this is a drag on society. People want to move on, and so that's why a short sale is the best way to be proactive and accomplish that goal.
All right. Tom, from your perspective, what's the best way to get out of this mess? What's the best way to clear the deck, so to speak? I mean, Jack mentioned this shadow inventory and things not going well until that happens. From your perspective, what could happen that would help?
Well, I agree that obviously we have a timeline here and it's continuing and there's a tremendous number of these, but they're just working through it. But as they have been working through it, we've seen some changes. We've seen judges who are coming to learn how to grapple with the volume. We see attorneys that are sprouting up in the area of defense of foreclosures. And all of this is moving along to come up with a cohesive scheme of figuring out how to deal with it. And it's tough, but they're working through it. But from the standpoint of the individual, it's really looking at the whole picture and figuring out what the best option is for them. But ultimately, I think it's just slowly working itself out, and we're going to come to a conclusion, but it's just going to take some more time.
All right, we'll talk to some realtors and people in the real estate business in a minute about the impacts. But in terms of, we have legislation pending in the Florida legislature that would essentially move to speed up foreclosures. Just a quick take on whether you think that's good or bad legislation.
I think it's atrocious legislation. I think there is nothing good about that legislation whatsoever. I think it deprives people of due process of law. I think it's trying to address problems that really don't exist. Now, there was, admittedly, and people in the foreclosure defense area, both plaintiffs and the defense side will note that when this first started, the courts were inundated, we didn't have procedures, but now we've worked through that. So the processes that are in place are good enough. And the legislation that's currently pending is awful, and I just pray that we really get a grassroots effort to quash it. We don't need it. It's not beneficial. What we've got in place is good enough.
Okay. Tom, any thoughts on that? Or
I'm not going to dispute her on that. From my standpoint, the legislation doesn't affect the major part of the type of business that we do. Whether or not a foreclosure goes quickly or not quickly, from the standpoint of the lenders that have unsecured second mortgages, they're still going to be out there chasing people. They're still out there looking to try and get their money. And independent of the foreclosure process, people need defense attorneys like Nancy and others who can sit down with them and figure out how to try and solve that equity line that may hang out there even after a short sale. You got an attorney like me who's still suing, representing the bank, and coming after people for whatever assets they may have. So I'm with Nancy. I mean, it's not, we're working through it. It's just taking time. We're figuring it out, but the legislation pending doesn't appear to be the proper answer.
Harold, you talk to a lot of agents and people in the real estate buying and selling business. What are you hearing from them in terms of what they say they want to see happen? What would help restart the market?
Well, according to some of my readers who send in emails that with nom de plumes, I'm risking my job by saying this, but the agents that I talk to, and they tend to have experience. I don't talk to hobby agents or part-time agents, but the ones who have been in the market for a long time. They are seeing good signs of improvement in the market in terms of the number of transactions and the volume. Certainly seeing a lot of foreign buyers, Canadian buyers. That loonie that we used to laugh at is now all of a sudden strong, and we have a lot of Central American and South American buyers coming to Florida, as Jack said. So hearing good things from real estate community. Yeah, right. We'll see how it plays out with this shadow inventory, as to use a phrase that has been batted around for years on end now, but I haven't heard any agents complaining this season.
All right. Michael, what are you hearing from your contacts?
Well, what I'm hearing is that banks are embracing short sales, especially from Sabrina, who I talk to a lot. That Bank of America, which used to be the worst in far as dealing with foreclosures and loans moving through their system, now they've got a graphic that they send out to their clients that shows them all the different possibilities that they can have to get out of their property, from short sales to deed in lieu to foreclosures, and then what are the allows them, their customers, to do a cost benefit analysis as far as what's best for them. So I think banks are also moving towards thinking, hey, this is better than foreclosure. Foreclosure takes a long time, it's costly, let's get these things moved. And it's, if we can relieve some of the borrower's debt, then it's a win-win, even though I hate that term, but it is a win-win for both the borrower and the bank. The bank, gets to get this thing off their shoulders, and so does the borrower.
It's a smaller loss for everybody rather than being a win-win. It's a small loss rather than a big loss, big loss.
Or it's a lose-lose.
Yeah, little lose.
Yeah, little lose.
So just real quick, I'll ask both of you, or Herald mentioned that you hear from a lot of full-time agents, but have you noticed, is there a difference between, say, contacting and dealing with, as a reporter, dealing with big banks and community banks? Do you get responses from both? Neither? Sometimes?
Well, I'm not just saying this for Bill Sedgman, who's here, but it's much better to deal with a community bank from a reporter standpoint than to have to go through layers and layers and layers of management in order to talk to somebody. Bigger banks just can't talk to you locally. They're not allowed to.
Yeah, I asked a big banker one time, do you do mortgages at your bank? They said, well, we'll have to refer you to corporate communications.
It's funny, when Jack was talking, I heard a lot of uh-hus in the audience. But if we have to, again, back to kind of the idea of some of the programs that have been established to try to clear the backlogs and help people stay in their homes or modify their mortgage. For the two lawyers, are you hearing that, are those working? Have they worked at all? Have they not worked? Because if they haven't, why?
The HAMP program was the government's big rollout mortgage modification program. And by all accounts, it has been an abysmal failure. And the administration has admitted that it hasn't accomplished. I think it was supposed to save 4 million homes, and it hasn't even come close to that.
Do you think that's, I'm sorry, do you think that's because the program was flawed, or there wasn't enough money in the program, or the problem was just so in-depth, so great that you just couldn't solve it with anything?
I think they didn't have the resources to properly implement the modification program. So I have yet to have a client submit their paperwork, and then lo and behold, a modification comes in the mail. It's always, I submitted this, they didn't get it. I called, I have confirmation. So there was a lot of rigmarole that it just wasn't being processed properly. And then you have the issue of, Mr. McCabe had that experience of a significant principal balance reduction. I'm not seeing that. The best I'm seeing is that they take everything that's owed, put it on the back, re-amortize you out for 40 years, and reduce your interest rate. So to the extent you're significantly upside down, it's not always in your best interest to keep the property. And so the modification programs, as they currently are, in my opinion, have been a failure.
I think that lawyers use this highly technical legal term, kicking the can down the road. Isn't that something you've even used? Yeah, except in Latin form, probably.
Yeah. So, Tom, what do you think from your perspective? Do you ever just, like, when you have clients who are lenders, do you ever just go, work with me here, give me something to offer to the other side, maybe at the risk of offending any potential clients?
Oh, that's fine. There's two answers to that. One that I would answer if I didn't have this on, and there wasn't a camera over there, and the other is the answer I'll give you. I work with banks. It's a struggle for the individuals out there to get through. They call and call and call. Months go by. They don't get return calls, and it's difficult. I have challenges myself in dealing with some of the clients, but overall they've gotten better and better, and they have developed a system to at least work with people. They want to make a proposal to resolve a case. We tell them what kind of financial information we need. They give us all the financial information. The bank comes back. They still say no. I fight with the bank. And it's really a matter of going to war with the bank. Even though I represent them, I'm trying to get a deal done. So a lot of times we're going back to the bank and I'm fighting with my own client. But that's not unusual for attorneys to try and bring some sense to the situation for the betterment of everybody.
Yeah. So I'd like to hear the answer afterwards, the answer you wouldn't give.
No problem. There's some Latin involved.
Yeah. Yeah, I'll get to you in just a second here, Harold. Let's segue into this shadow inventory. What do you, Michael, and we'll go down the row, what are you hearing? Is there a shadow inventory, and when is it, well, yeah, and if not, when's it going to show up?
Yeah, I think that Jack's numbers were right on that. Was it, Jack, like 1 million shadow inventory of like homes that are in the system, 900,000 homes in Florida, or
900,000 in foreclosure or in default, and another 150,000 held in REO by banks, over $1 million.
So 1 million distressed.
Yeah. And then you're also dealing with the possibility that there could be more strategic defaults as you move forward, where people just say, you know, forget it, I'm not going to push this rock up the hill. And so that could add to that total number.
Okay.
I mean, why not get out of think about how many homes were sold during the boom east of the interstate. That's how many people are underwater.
Yeah, ironic that they're east of the interstate and underwater. Nancy,
Yeah.
Nancy, in our pre-discussion, I don't make it sound like this is some secretly arranged thing, but we do talk with the panelists. You mentioned some signs that you're seeing that maybe not everything has shown up so far.
Yeah, definitely not. I'd say in the past month, I've had over a dozen clients retain me on foreclosures filed where they have been in default for more than 2 years. So in normal foreclosure world, pre-boom bust, you miss 3 payments, you go into foreclosure, the foreclosure takes 3 to 4 months, and it's the end of the game. I have never, ever seen somebody be in default for 2 years before the foreclosure is even filed. So that makes me believe that there is a lot of shadow inventory out there that's not even in the system, not counting the 12 to 15,000 that are currently pending.
Tom, is that your sense?
Well, the shadow inventory is better addressed by Nancy because it deals with foreclosures, but the inventory that I see is the inventory of debt. And Branch Banking and Trust and Regions and Wells Fargo and some of the others, they send us a volume of equity line lawsuits on a regular basis that we file suit on all over the state. I don't know what the numbers are, but probably have 1,000 of them going on at any one time. But I have been informed that the numbers are dropping, that the numbers that we have been receiving now that are initially worked by collection agencies, then they come out to the attorneys, are being reduced by 30%. Over the next several months. So what's funneling into the collection agencies and ultimately to me on the equity lines is being reduced.
All right. So. Harold, ask the same question to you.
I would say the high water mark of underwater properties extends far west of the interstate, not just east of the interstate, depending on which latitude in the county that you're talking about. But I wanted to defend the banks, if that's possible, by saying that the concept of a short sale and certainly a loan modification, this is so rare. I mean, short sale used to be a terminology on page 85 of the real estate dictionary. Nobody ever thought they'd ever do a short sale, and a foreclosure was somebody that just decided, instead of paying my mortgage, I'm just going to, you know, drink my way into oblivion and sail around the world for a while instead of paying my mortgage. I mean, it just didn't happen. We've always had appreciating home values ever since we established our current mortgage system. So it took banks a number of years to just accept the concept of the short sale. So finally that's happening, and I think it's the only way out of this mess. I don't think that the government's resuscitatory efforts are going to work anywhere near as well as just people, lenders and debtors, getting a different mindset. And I think we're starting to see a different mindset come into play.
All right, terrific. You set me up. Can we have a mic here, a handheld mic? And let's ask Bill Sedgman. And you can come stand. There's a little X right there that Charles put. And if you can kind of face the audience and then toggle back and forth. So I'll just stand over here. So tell us, has your mindset changed at your bank, Community Bank, right? Community Bank, got it right. And has your mindset changed, and how are you approaching foreclosures, short sales, and then also tell us a little bit about what's changed, if anything, in lending standards?
Well, I think the short sale makes a lot of sense. The problem that has been so difficult and why some of the banks have delayed is the regulatory scrutiny that banks are under today. Because once you take the short sale, you recognize the loss. But still on your books, you can argue that values are there and the borrower will start paying and all is well. So when you have so much pressure on increased capital that you read about, banks have been asked to increase their capital levels at the same time their earnings are in the tank, and then you say, well, wouldn't it make sense? Because it does make sense to short sale. Because you're going to take it back in REO, and then you're going to have the same loss. So why not pass it on to your client as opposed to somebody you don't know? So it doesn't make sense for banks not to do it. But if they've been slow in doing it, it's painful to take those dollar write-downs, and you're talking about millions of dollars. Now, community banks didn't create the mortgage crisis because we didn't do them. My bank didn't make very many home loans. If we did a dozen a year, it was an exception. We've done a lot more recently. We're probably doing 25 or 30 closings a month, and that's from 0 closing a month 2 years ago. We're doing foreign national lending, and we're doing condo lendings in stabilized environments. And if we can get budgets that are close, we don't have any national standards to go by on what stabilized is, because we're buying them we're booking the loans in our portfolio and not trying to sell them off.
All right, terrific. Thank you very much. Michael Saunders, you can join us here on the X. X marks the spot. Tell us a little bit about what all this being foreclosures and short sales, the impact on your real estate business.
Do we have dinner being brought in and breakfast in the morning? Oh, I applaud the panelists. I applaud Jack, because I think that we are in the, 7th year of a very, very long slog. And I think that the answers are not easy. They aren't the same for everyone. I think we haven't talked about homeowners who are not in foreclosure. We are not talking about homeowners who simply want to move on with their life and do something different, move and be near their children somewhere else, move up, move down, move around. And short sales and foreclosure has impacted property values and prices everyone could sell their home for everywhere in the country, and particularly in Florida. So it has impacted every aspect of business, not just those that are underwater or have lost a job, but every single homeowner has gone through the impactful nature of what this has done to property values. We also have to remember that we were sitting very pretty with property values racing up 85% from 2002 to 2006. So we all felt pretty smug about that. Wasn't sustainable. Jack was right. Over a 5-year period, a 25% increase in value historically over the last 70 years has been what property owners could expect. So when you had an 85% run up, you had to give it back. So it's impacted the retail market. It's impacted homeowners, thank goodness, banks. And I think, Michael, you gave a great example of somebody who bought a $250,000 house and got a $250,000 mortgage. That's what was wrong with the picture. So the banks kind of had to pay the consequences for that. Fortunately, I think they're seeing the consequences of allowing things to go to foreclosure. Because if they would work on a short sale, they would probably recover 20 to 30% more than they would if they allowed the property to go to foreclosure. I think the other thing is what foreclosed properties do to a neighborhood. It is not just the value of the foreclosed house, it's what it does to a neighborhood. I mean, we'll ask another question. How many of you have driven through neighborhoods with foreclosed houses where when the bank says secure it, and we do REO business, I mean, that means board it up, change the locks, how many green swimming pools. What do you think that does to the value of the property next door? So, I mean, it is something, and I think Nancy made a great point. I mean, we have cancer, we have autism, we have Parkinson's disease that we've been trying to work on cures for years and years and years. This is not killing the patient. I think Nancy's advice, Jack's, that you have to deal with it and move on. This isn't life and death. It is serious. It impacts families. It brings tears to your eyes. You suffer with them, you feel for them, but you have to give them the hope that they have their health. And that, so I do think, I mean, there's so many things it impacts.
All right, thank you very much. Harold, you had a, yeah.
Give me a microphone.
And I think I heard the words, Jack was right.
Jack wasn't in the room when I said that.
Yeah. We can replay. We'll get you a special edition copy of this, signed by Michael Saunders. Harold, do you have a question for, I believe, an appraiser? And you
yes,
just call him up.
We do have, I made an effort to invite an appraiser because appraisals have been a sticking point. Michael, are we still seeing problems with appraisals, yes or no? Judging by the sigh that she just delivered. This is Howard Graber, who is a veteran Sarasota appraiser. And if we could use Sarasota appraisers. So what's the deal with appraisals now, and are we still having an issue with appraisers coming in from Lakeland who just got out of, they're younger than Nancy, for crying out loud, and they don't know anything.
Well, what happened a couple of years ago is the federal government decided that a lender could not direct or choose their own appraisers. They could decide who would be on their approved lists, but they could not say this particular appraiser is best for this particular job and direct it to that appraiser. Some lenders have solved that problem or trying to solve the problem by having their own, call it an appraisal coordinator, somebody who is not a processor, somebody who's not a loan officer, be the one to order the appraisals. However, that person can't direct it either. Typically, they'll go through a rotation, and that rotation hopefully has local people. However, when you start dealing with non-local banks, many of them use what's called an appraisal management company, which puts another layer between the lender and the appraiser, which does two things. Number one, you don't know what you're getting half the time in terms of who's going to show up. And number two, it increases the cost of the appraisal for the consumer, which is not what the whole deal was supposed to be. It's called the HVCC, Home Valuation Conduct Code or something like that. But that is a problem. I get a lot of complaints from realtors who tell me that, you know, they show up at a house, and in fact, I had one guy today, I had met him about 6 months ago on Siesta Key. Everybody likes a good story, I hope. And I'm in this $2 million house, and he's very, very happy to see me. He's thrilled. He can't believe they sent somebody from Sarasota. And I said, what's the problem? Why are you so happy, Bob? And he goes, well, I had one last month where the appraiser met me at the house, and I was about 3 blocks from Siesta Beach. And before he left, he asked me how to get to the beach. And I knew I had a problem right then and there. And the guy was from Clearwater or something like that. So it is a problem in terms of getting the right people to do the job. I did want to take a second, if it's okay though, since this is about short sales, we're doing more short sale appraisals probably in the last 6 months than in the last 3 years. And many lenders, what they were doing initially is they would do what's called a BPO, a broker price opinion. They would have a realtor, an agent come out and just do a short thing and say, here's how much it's worth. They didn't want to spend the money to have a real appraisal. I think more of the lenders right now are starting to actually order an appraisal, an independent third-party opinion, and utilize that in their decision-making in whether to do a short sale or not. Now, there's a couple different ways to do an appraisal for a short sale. Some lenders want me to do a regular market value appraisal. So it may be an appraisal that's a number based on normal marketing time, and that's market value as defined in the Fannie Mae and Freddie Mac appraisal. Some lenders additionally will have me do something called an REO addendum or some sort of thing like that, where we give them additional numbers, and those numbers may be liquidation value numbers. They see that, okay, if I have the thing for sale for 6 months, maybe I can get this, but if I got to get rid of it in 30 days, what do I have to discount the property for to make the thing sell? And really, if you're making a decision for a short sale, I think it's really important to look at both those numbers as a lender to decide, which way to go.
Great. Thank you very much. That's great. Thank you. Pat Neal, you have the distinction of being the last person that we're going to ask questions of.
Yes, I'd be the only thing standing between them and dinner or whatever else they wanted to do.
Okay. Pat, if you just, actually, you can look to the camera there. And what I wanted to ask you about is what foreclosures, for short sales, the general market, have done to change your development practices.
Tom, as you know, I'm a new home guy. I think I'd like to make 3 points. First, for the most part, those of us in the new home business don't compete with the short sales, the empty houses, the homes that have been vacant for 2 years. Because that home has been stripped of its copper and no longer has a condenser. It's been open for two years. It's full of mold. So for the most part, we're not affected by the crisis that you see. And from a perspective of jobs and employment, I guess that's a good thing. Another point I might make is that we've all focused in this meeting since I've been here on the supply side, the fact that we have so many of these houses, maybe 15,000 in Sarasota and Manatee County. I might propound the idea that we should talk a little bit about the demand side. We can sell homes if people have jobs, they have incomes, they have support, they have a reason to come to Florida, they have confidence in the future, and they can get a 620 FICO score so they can get a loan from Bill or from Wells Fargo or anyone else. And I'd like to end on a little more optimistic point than I may have heard from everybody except Michael, is I think this crisis is to a large degree, I just want to say, I think it's largely behind us. I'm optimistic about how our world is going. We're certainly optimistic as a company as to how we're doing. And I'd like to say, even though it's been a crisis, we're Americans. We've seen this movie before. Bill and I saw this movie in '68, '74, which was, of course, a credit-driven crisis. '82, S&L crisis in '89. We saw it in 2001 after the 9/11, and we see it now. It's part of our world. We need to roll the punches and increase demand. That's my story.
Perfect. Thank you very much, Pat. Great. Thank you. Okay, now, I promise we are very close to keeping my promise of having 25, 30 minutes for questions and answers. Jack will be here. You can pose them to Jack. You can pose them to the panelists or to anybody else who spoke. I have one little thing to say before we get into the questions. I went to church Sunday. I got my sermon. So I just ask that when you stand up and go to ask the questions, kind of remember that I've got my sermon for the month, and if you could just jump to the question, that would be great, and it will be much more respectful to the other people who want to ask a question. If you'll just identify yourself by name, and if you want to say what your profession is or whatever, that's fine. Somebody will, with the microphones, Danielle, will find you. Questions from the floor? All right, this is panicking. Okay, we've got one back here, and then you. Oh, is it? Okay.
Thank you very much. My question for Mr. McCabe is, we've heard the numbers on the foreclosures, the short sales, the delinquent loans. How many properties are there in the state of Florida? What's the universe that we're dealing in here? You're talking about 350 foreclosures in process and another 400 or 500 delinquent loans. How many loans are current? How many loans are in place? How many properties are stable in the marketplace we've got today?
Great question. In Florida, can you hear me okay? In Florida, there's approximately 11.1 million residences, and we have over 18 million in our population. About 30% of those are owned outright, where there's no mortgage involved. So you've got roughly 7 million that involve mortgages, and out of those, about 1 million are in trouble. So about 14%. Or 10% of the total, correct. That would compare in a normal market time to about 1 to 2%.
Of course, the hidden part of that equation is that a lot of those 30% who own their homes free and clear are counting on selling that house so that they can retire to a smaller residence or assisted living or something, and they're not going to have as much equity as they thought they did. So that's, even though they have no mortgage, doesn't mean that they're not going to pay some kind of distress.
And it's not just people that bought since 2004 and bought too much house that are in trouble, by the way. There's a lot of folks that bought their homes in the 1990s and took out second equity lines of credit, second mortgages. They put the kids through college, they took vacations, they bought boats, they bought new cars. And even though they've owned their homes for 15 years, and even though they were cash positive and had strong equity, they're now upside down because of those home equity lines of credit.
All right, yes, sir.
I just want to make a comment. My name is Tom, and I'm with Keller Williams. And I feel, like the gentleman up there, that lots of people are coming to Florida. And there's a shortage of homes out in Lakewood Ranch. Building is going on. I had an offer on a home, on a condo right at 1 Watergate. There were 4 offers over the weekend, and it sold. Not my offer, but I feel that things are going to improve. The people that are coming, they have cash. There's 90% of the people in the United States have jobs. So, and what our unemployment's only 8.3% and improving. And Florida is the place that they're going to be coming. So the doom and the gloom, I think, might not be there. Yes, we have a large amount of homes that are going to be coming, and I'll end up here onto the market, but if they come out slowly, it will not impact us that much.
Okay. Questions? Anybody? Any other questions? Any questions? Sure. Lady on the aisle there.
Gee, I can barely get up. My name is Marika, and I'm thankful, super thankful, that I don't have to be a realtor anymore, because I was one for 30 years, and I don't have to do it anymore. What I'd like to find out, though, is from the appraiser, when it comes to appraising properties, particularly condominiums. I've heard horror stories where a condo or a villa is appraised even though there's a lot of short sales or there's foreclosures which are being sold at ridiculously low prices, and then regular responsible people who are trying to sell their properties can't get someone to buy it and get a decent mortgage because the appraisal is taking in all these low foreclosure sales and not really the real price of the decent property. So how do you look at villa and condos when you're doing your appraisal?
I guess that's me. Well,
stand up for us.
Yeah.
So TV can get you.
What you have to do when you're appraising is you have to look at the pool of potential comparables that you have. If I'm appraising, let's say, in Northport, right now there's not much down there selling, at least 6 months ago, that wasn't either a short sale or foreclosure. That's the market. It depends on the condominium. It depends what's going on in there. If it was, say, a condo that was, say, a conversion that was done in 2004, 2005, that particular condo may be flush with short sales and with REOs, and that's what you're going to get. If it's in a condo that's been around for 25 years and there's not that much distress stuff going on, and there's regular comparables to use, the appraiser should use the regular comparables. A short sale isn't necessarily a distressed sale, okay? An REO bank sale usually is. I've had situations where we've had a market grid with 2 regular arm's length sales. One sale was a short sale, and the short sale adjusted higher than the regular sales. You have to look at each sale individually and decide whether it looks like an appropriate sale for what you're doing.
All right, great, thanks, good. Next question? Yeah, sure, right there.
I'm retired, so I'm not in the business, but in our community, I have a condo in the Meadows, and we've recently had 2 short sales within my association. And of course, they were low-ball prices that they went through with, which are considerably under the prices that people have paid for those properties in recent years. So it leads me to wonder how many more of these are coming down the road, and how will it affect the remaining occupants of those condos in the community?
It's a good question.
And another follow-up question. How can a person identify the sales figures on short sales when we read about how many units were sold in the month of February, let's say, and there's 1,000 in Sarasota County? How many of those were short sales? How do we know those numbers?
All right, how do we know them? How many more to come, and how do we know them?
Ask your realtor.
There's several different sources. MLS would be one. There's research firms like CoreLogic, Lender Processing Systems, RealtyTrack that also track this data on both a county and a national level. As an example, in January of this year, I believe there was slightly more than 1,200 sales in Sarasota County. About 38% of those were either an REO or foreclosure or a short sale. The month before in December, it was about 32%. So right now it's running about 1/3 of the market or more, and I expect that that's going to continue to escalate this year.
All right, thanks, Jack. Michael, you want to take a stab?
Yeah, but I also think Michael was right. Michael Saunders was right. Ask a realtor. They really do have that number. They have that number. And what we ought to do as a newspaper is publish that number every month. And that's what we'll do.
There's Mike Conley right there. You take it right to him there. Great, thanks. All right. You wanted to ask a question.
No, I thought I was just going to call it. Sabrina had her hand up.
All right.
I want to make a comment. I'm a listing short sale agent, and I would have...
Use the mic.
My name's Sabrina Sullivan, and I'm a listing short sale agent, and that's what I do. And we have good news. That's the thing about the process. We're far enough on now that there's actually systems in place. So between the government programs, the fact that the lenders are on board now finally, the appraisers finally are coming in, and the real estate firms know how to work with the situation, things are getting better. We're going from a 6-month process, sometimes down to a 45, 60-day process. The attorneys in the local community are very well versed in the programs. They know what to do. I've actually had the pleasure of working with some of the senior vice presidents at Bank of America and asking them what they need from us and then getting from them what we need in the field. And that really helped get the appraisers out so we weren't getting bad numbers. So that's helped all of us. And a couple of things that people really need to know is that the hardships levels that the lenders will accept have changed. It's no longer just financial. It's familiar status, like Michael referred to, Ms. Michael Saunders, that if your family size changes, that's a hardship. If you need to relocate for a job, that's a hardship. So as Nancy and the attorneys will tell you, yes, you can take $100,000 out of your bank account to make up the difference, or through the government programs, you can find out if you're eligible on one of these programs. So there is good news. I think there's great resources in the community, and just reach out to people. And I think your realtors first, your attorneys second, and you can get all the information that you need locally.
Great, thanks. And just so everybody knows, we are going to have a special Facebook page, and we'll give that address later. So if anybody wants to go on there and post their information, how they might be able to find help, et cetera, that would be a very convenient way to do that. Okay, yes, sir, right there. Yeah, right there. If everybody could just make their questions as short as possible so we can get as many in.
My name is Boyd Cowper. I'm a realtor, and I have a question of our banker. I was here in 1974, and I was here in 1982 when we had the same situation that we have right now. The difference then was that we got out of it a lot faster because the banks were willing to loan to investors. Now, right now, the banks don't want to talk to investors. It doesn't matter if you have a net worth of $1 million. They want you to have a job, and they want you to see a lot of cash flow. So what I can't understand is we got out of the last two recessions by banks lending. Like if an investor owns a condo.
Okay, so we'll ask Bill.
Let me
are you lending to investors?
Just one more question. Is if a man owns a condominium in a building and he wants to buy another one, he can't get a loan because he already has a second home. Yeah, and so they won't.
You want to know why you can't?
You can't buy multiple units.
All right, so Bill, are you lending to investors?
That's a very good question, and the answer is yes. The problem you're having is most of the borrowers or the investors want to get the 30-year fixed rate, and that market doesn't loan to investors. But if you want a portfolio loan, typically a 5-year adjustable, and you've got the income to cover the payment on the house if it doesn't, or the unit that doesn't rent, then you're eligible. And we'd be welcome to talk to you. We're a community bank, we're in the phone book, and we have money to lend. The difference between, and Pat knows this really, really well, but the difference between the two recessions you mentioned, where they were project driven. They were driven by S&Ls in the development business. And they were large-scale units that just needed to be completed when the markets stopped. This recession in housing is much more broad-based, and it was caused by everybody wanting to buy three because they were making so much money, and finding the lenders were willing to do it on no income, and then there was some not too savory practices. So I think this euphoria kind of created the excesses we have now, and it's totally different than what we saw in 82 and in 92. Do you agree, Pat?
Good, thank you, Bill. And Pat Neal agrees. So.
Yeah, the movie we saw back then was PG-13, and this movie is R, at least, maybe X.
X. Yes, ma'am, right there. We'll run the microphone to you. Thank you.
Yes, thank you. I think this was a wonderful session. This is probably a little bit different of a question. It's regards the property assessed clean energy, and from a legislative perspective, I really am trying and have been researching desperately to find information from the real estate industry with regard to this. I tend to look way out and see what the unintended consequences might be, as we're experiencing the subprime lending consequences, and I really would love to see and hear what the potential might be with regard to problematic marketability of these homes that have liens in a negative amortization type of situation now. You know, we may have loans on these homes that are not valuable enough to have $10,000, $20,000 sitting in a lien and may not be able to sell.
Sure. Does anybody, that was a good question. I don't understand it. Does anybody, I said it, does anybody understand it and want to answer it? All right, you're going to have your own Facebook page, all right? And, but yeah, you know what, that would be a good one if you would post it, and we'll, where's James? We'll get that out. We'll get that question out. The front row?
Yes, if you are an investor and looking to pick up some short sales, is it best to go through a realtor or straight to the banker? I haven't heard from the banker yet.
Who wants to answer the question? Realtor? Banker?
Can you talk directly to the bank?
Can you talk directly to a bank?
Well,
All right, we'll let Jack sort this out.
At the risk of upsetting a few people in the room, if you're an investor, your best route is to find a realtor who has close contacts with the lender. Now, if you're an investor and you have buku bucks and you're looking to buy a bulk of units, then I tend to think you may have the opportunity to talk to somebody in the special assets division at the bank and let them know how many different units you're looking at acquiring, and that they may make an exception and deal with you on a direct basis. But it depends on how much you're looking to buy. You go into a bank and you say, I've got 10 million bucks cash and I'd love to take 70 homes off your books for you right now. You may find that they'd be willing to sit down with you.
Yeah. You know, I used to be in that special assets division, actually, right when I got out of college. They're very special. So, okay, briefly, Michael Saunders.
I can't believe it. I agree with Jack the second time today. This is really hard to believe. But banks will not talk to anyone unless they are very, very large investors with very big dollars. So then it's to deal with a realtor who can show you comps, who can help you and steer you through the process. So,
all right. Let me ask Pat Neal real quickly.
Most short sales are listed on the MLS too. So.
Yeah. Pat Neal, so where are developers getting their money to buy properties these days, if they are?
Cash, earnings, equity, investors, hedge funds, commercial banks, 221D4. There's really, if you work, we have this great economy, and people who are smart are buying stuff now. This is the time to buy. People are coming into the market, and I think our credit sources are coming back.
Good. Perfect. Thank you. Yes, sir, in the back.
Jim Toll, I'm a real estate attorney. The question is, will 2012 be the year of the pre-approved short sale? And if Howard could maybe comment a little bit on what impact that might have on the market in general, and particularly short sales. It seems that Bank of America as servicer, Fannie Mae as owner of this debt, has stuck their toe in the water, but it's just scratching the surface at this point in time.
All right, Jack, you real quick, and then Nancy and Tom if they want to chime in.
The one that I've seen making the offers to debtees right now, or the people that have the mortgage, is JP Morgan Chase. I think that they have been blazing the trail and leading the way. I see Bank of America now is kind of sticking their foot in the water. I expect Wells Fargo and Citi and the other majors to follow suit in the near future as well. But right now, JP Morgan Chase is actually sending out paperwork to the people that they have loans with, soliciting them to perform a short sale. I mean, it's just north and south pole from what it was a year ago.
Huh. Nancy, Tom, is that are you experiencing that in your practices? Are you seeing that?
Jim, wouldn't that make our lives so much easier if there were pre-approved short sales? That's part of the problem that there's always been, is you're playing a game and you don't know the rules. They'll tell you a short sale is a privilege. There's no short sale laws, so it's just kind of how things are developing. A pre-approved short sale would be a dream for me, because then we know what they need to get to make the transaction work. Otherwise, you're kind of shooting in the dark, just hoping that you can push it through the system. And I think that would do a lot to speed up the process. And also having a knowledgeable realtor to work with helps drastically.
Tom, on your side?
You get so many headaches in a short sale. I'm shocked that you realtors are able to jump through all the hoops and get it done. And I'm impressed. I mean, I see these realtors. They got to deal with me. I got a judgment lien on the property. You got to deal with the bank who's fighting you. You got an equity line out there. You've got lawsuits. And you got a confused buyer and seller to try and do that in advance. I'll be shocked, but who knows? Maybe one day. Not now, best I can tell.
All right, so that will be next year's forum, 2013. All right, one more question. Yes, sir, you over there. You've been patient. All right, last call.
Hi, Rick Koenig is my name. I'm a retired realtor. I'm now in commercial lending doing sale leasebacks. and that's a totally different market. We get our funds from real estate investment trusts, insurance companies, Wall Street. And that business is booming because there's all kinds of money for investments. They're big investments, and as I say, the business is excellent. It's a soft spot in the market for us. What do you think is going to happen, excuse me, if interest rates go up just a little bit? How much shadow inventory is there going to be if people who are, we'll say, underwater slightly, but then have to pay more money for their homes?
Great question.
It's my feeling that that inventory is going to go up big time.
What happens if interest rates go up? Jack?
You know, what's interesting is everyone said that as interest rates went down, that sales would increase. And quite honestly, I don't think that's really happened. We've seen a recent trend where there's been more sales maybe over the last 6-9 months. But we really haven't seen, because basically banks were not, even though we had great lending rates, people were not able to qualify for mortgages, and it's by and large been a cash buyer's market, especially throughout a lot of Florida. When interest rates go up, I think you're going to see a number of things. First off, anybody that's living off of a fixed income relying on interest rates is going to be jumping for joy because they've been very hard hit with these low interest rates the last several years. Generally, when interest rates go up, it shrinks the buyer's pool, and it's kind of puts the brakes on appreciation somewhat as well. So it will have a temporary effect of getting a lot of people off the fence that may have been thinking about buying, and it'll get them to go ahead and buy before rates go up. But it's usually a temporary surge. And then after that, you're pricing more people out of the market. As interest rates go up, you shrink the buyer's pool. So, but the problem is what makes normal sense has been anything but normal over these abnormal times. And it's really hard to figure out exactly what's going to happen. When interest rates go up, you know, when prices go up, what's going to happen? Well, there's probably a lot of people that are sitting on the fence, would love to sell their homes right now, haven't put them up on the market, but as soon as they see the market getting better and prices may be increasing, we may get hit with a flood more inventory of people that have been holding off, waiting for the market to return. So there's a lot of different things that can happen, but until we get to a more certain, stabilized market, I don't know if interest rates going up is going to have any effect at all, just like it didn't have any effect with the rates coming down.
All right, thanks. And I tell you what, since I'll take moderator's privilege, since Michael agreed with Jack twice, she gets a 30 seconds.
This is 30 seconds.
Because I've got my promise to get everybody out of here.
What is certain, I think everybody feels a little paralyzed with the news they've heard today. But what is certain, we have never been busier. Inventory has never been lower. There are more multiple offers than we have ever seen. So if anyone is thinking of selling, this is the time to do it and take advantage and buy one of Pat's new homes, because there is no inventory. We are down to 5 months of inventory for under 300,000. So if you want to sell, this is the time to do it. We're even having listing contests. I never thought I'd say that. So there is some good news and a window before the shadow inventory begins appearing.
All right, sold. Thank you, everybody. I'd like to thank Jack for coming over from the East Coast, my colleagues Michael and Herald, Nancy and Tom. Thank you, everybody. Let me just do a little housekeeping very quickly so you'll know where to go. I lost my page here. James, help me out. Where do you go? Facebook? Facebook URL?
The URL, there you go. The URL is at the bottom of your agenda for today. It's also at the bottom of the survey that you were given. And I would ask that you, if you're a Facebook person, please go to Facebook. It's Herald Tribune. It's facebook.com/HT Hot Topics. So go visit that page, post your questions. We'll work on getting answers. We hope that we'll continue the engagement there. Also, let us know what other hot topics you'd like to hear about. And that is back to the paper survey that you have in your hands. Hopefully you got those when you came in. please complete those surveys. Your feedback is very important to us. We want to know if you like the quality of the speakers. If you didn't like Tom, just say it. Put it on there. Now, Tom, we really do want your feedback, though. We want to know what other topics you'd like to hear about, if there's something more about real estate that you'd like to dig into. And we'll continue to take that advice as we go forward with more hot topics in the future.
Great. Thank you and good night.